Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered financial advisor, registered investment advisor before placing any trades. Oh God. Let's try this again. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStarWorld.com, PSW, nor its affiliates, or any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacity licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics of standardized options. PSW provides education and training services and meant to teach the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not blind guaranteeing any profit. As always, do not trade the money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary by accessing this webinar. You agree to be wholly but harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. There we go. Fantastic. I feel good about that. How about you guys? All right, what's going on in the world today? Let's take a look. Here's the indexes. Whoopee! We're way up, except for the Russell. Look at the Russell lagging. That's not good, because the Russell is barely holding the line, and it's only up a half a point. Look, these guys are up in proportion to how much. That's not the Dow. Didn't that happen last week too? Why does that keep popping up? Must be my default somehow. Look, 200 of these 300 points are because of Boeing and Apple. $8 times about $8.50 per point on the Dow. So that's going to be about 75. 8 times 8.5, 68. Oh my God, I thought it was way more than that. Okay, so it's 68, and then Boeing is up, gotten is what? Let's see. BA. Whoa, Boeing's up 25 points? Holy crap. Well, BA got expensive. Damn, we used to own them when they were like half that price, not even half. They were around $100 when we used to own them. Can't believe we ever let them go. That's annoying. Okay, so 25 times 8 is 200. So Boeing by itself is 200 Dow points. So basically, Boeing and Dow are up. And in fact, here's a good way you can look. When you see a big Dow movement and you're wondering if it's because one stock did it or something like that because of some huge report, you go to Yahoo and you say, well, this is a tricky part. You say up DJI, I think it is. There it is, Dow Jones Industrial Average. I guess you could search for the Dow Jones Industrial Average. Anyway, get to the Dow Jones Industrial Average and you look at, you're supposed to look at the holdings, components. So here you go, components. And look what happens. You get a nice list of all the separate components and how they're doing. And then you can see, is any one particular stock. Now, knowing the Dow is a price-weighted index, unlike the other indexes, you can see the whole index. I mean, you can look up the NASDAQ, but it's easy to see. There's only 30 stocks on the Dow. So you can just look and see, what's making the Dow go. So you see, generally, no big excitement, but except for because they're price weighted, right? So no movement, no movement, no movement. Here at 830, nobody else is even near a buck. Everybody else is flat. So the whole Dow is basically flat, except Apple, Boeing, Microsoft's up a bit, Walmart's down a bit, Caterpillar's up a bit, United Health is up a bit. But these are not very exciting things, right? The big movers here are clearly Boeing and IBM. And so what I would do, since it's earnings, is I kind of throw those out. But unfortunately, if you throw those out, the Dow is effectively flat today. So the Dow is around where the Russell is. Except now, if you think about the Russell, there's a bit of a knock-on effect. So when you see the Dow go up 300 points, of course the Russell is going to get a bid from somebody. People are going to start buying stuff. They're going to go, oh, things must be good. But you know, and I know that only two components are moving the Dow. And those same two components are, well, obviously Apple is a 20% of the NASDAQ basically. So if Apple went up 5.3%, it's 20% of the NASDAQ. You take 20% times 5 is a bit over 1%. So most of the NASDAQ move is directly related to Apple. The S&P, Apple is a huge component. Boeing, of course, is another huge component in the S&P. So, and Apple has a drag-on effect where if Apple goes up, a lot of the suppliers go up and so on and so forth. So, and then of course, the Russell is going to go up because all the other indexes are going up. So this whole day's movement is really kind of an illusion. I'm not negating it. I mean, Apple's strong earnings is probably going to lift Apple even higher than where it is now. I think our next goal was, I believe our first goal was 168. It was an 18-point bounce off of 150. And our secondary goal is going to be 18 points above that, which is 176. So that line there, basically 173.50, that's our next goal for Apple. But it's not necessarily going to go there tomorrow or anything like that, but just that's our next goal. That's a strong bounce of Apple off the fall from 230. And if you can imagine 230, well, let's see, there's 25. All right, so then another 25 is 200, and another 25 is 230. So 230 is like way up here. Okay, so Apple fell all the way from, I gotta try to use my finger like an idiot. Apple fell all the way from here. Okay, so figure like this RB, fell all the way from here to here, and now it's bounced this much out of this fall. That's what we call a weak bounce. Do not be fooled. It's nice, it's an improvement, but it's a weak bounce. It's not that big of a deal. But a weak bounce in Apple, since it's 15 points, well, so since it's, yeah, from the bottom, it's 18 points up the bottom. A weak bounce in Apple is a lot of Dow points. And Boeing's just blasting higher. I mean, that's a crazy start. It's not crazy. I mean, Boeing is worth every penny because Boeing is an incredible stock. They've got a 10-year backlog of orders. I only wish they would have had a dip that we could have gone in, but they just went up and up and up, and we never got a chance to get back in on them. But I freaking love Boeing. It's like incredible. It's probably the second favorite company next to Apple as far as like wanting to invest in it, or IBM maybe. All right, Boeing, IBM, Apple. Those are my three favorites. Anyway, so IBM takes a dip, I buy it. Boeing didn't take a dip, we didn't buy it. End of story. Anyway, so there's no real strength to this movement. It's really just because of IBM and Apple having good earnings. And that means it can easily be broken very hard and fast by something the Fed does that people don't like. I doubt it, though. They're going to be on hold and they're probably going to say dovish stuff. I don't think that's going to derail it. I think that it's really going to be a question of more follow through on earnings. But it's not I wouldn't consider this a strong foundation. And especially from the index point of view, it could easily be undone by other adjustments, people taking profits and such towards the end of the week. So we shall see. All right, Craig says, thanks for the MJ idea a few weeks ago. Yeah, it worked out nicely. What should we talk about? Well, before we go, let's talk about oil. Oil went blasting back up to 55, got rejected there, of course, 62.50 on Brent. Those are perfectly logical lines for them to get rejected at. The inventory report was so-so. It was a flat, but a bit of a build. Where do we write about that? Let's take a look at today's chat. I'm going to be on, in case anybody doesn't know, I'm going to be on Money Talk tonight. Okay, so it's a Canadian, this is BNN, it's Bloomberg in Canada. And they have this show, Money Talk, at 7 o'clock. And that's Kim, she's the host. That's me from the last time I was on. And I do the second two segments. I'm pretty sure it's the second two segments. I do two segments anyway, I know that for sure. And the first segment, we're going to discuss the macro economy. And the second segment, we're going to discuss the Money Talk portfolio. So the gig is that I go on there and I every quarter, and we keep this portfolio. We only are allowed to make changes when I'm on the show. So, I mean, I'm not on the show live. You can't get every trade in, but I basically will go on the show, talk about the portfolio, and say, here's how we're going to adjust it, or go to the website and take a look. And you guys get to see it early. So this morning we discussed it. And of course, I obviously sent it out to them as well to tell their viewers that they can prepare by, going to the thing. Wouldn't be right to not include them in that. But this is our most public portfolio, and every single move is made on TV, basically. It's doing really well. It's up about 100% for the year. It's up 111%. And we don't touch it. The key to this thing is we do not touch these trades. And that, more than anything, is what I want to focus on for you guys. It's just you have to realize that you don't need to constantly play with the portfolio to get it to have a good one. What I do with this portfolio as far as taking positions is obviously I take positions I shouldn't have to play with. In fact, someone asked me today, we made a new trade on IBM. Where's IBM? IBM. Made a new trade on IBM, and it breaks my heart sometimes. I mean, there's incredible opportunities to press a trade or do something that we have to pass. But again, it's not about optimizing. This is great for like people who travel a lot and aren't able to watch the markets or don't want to watch the markets, and they just want to have a decent portfolio. So we try to be diversified. We try to pick things that are very, very likely to succeed. We don't want risk. I don't want something I probably have to adjust. We're not scaling into things. We're basically taking a flat position and sitting on it, because scaling in requires a bit of timing. It's taking advantage of something at the right time, not just, at a random quarterly interval. So IBM, small trade, we have the trades we have. Where was that? Oh, the trades we have, and we'll go back over that in a second. See, every trade I say, here's how much we have left to gain on this trade. All right. So the trades we have are set for $152,000 and 476 worth of gains. And I'll get off on that in a minute. Minus the hedges, of course, 13,000 in hedges we should lose. So, we're in great shape. It's only a $50,000 portfolio. So if we're going to make $150,000 in the next 2 years, I don't think we should really be aiming much higher, should we? I mean, it's just, we're doing this using half our margin. Okay, and right now we've got $85,000 in cash. So that's been more cash than we started the whole thing with $50,000. 85 is cash, 20,000 in positions. So we have tons of margin sitting on the sideline, about $170,000 worth of margin available, and we probably used about half of it. I don't want to add a lot more margin though, because I'm trying to keep it in bounds of a $50,000 portfolio. So I can't use, just because I have because we've made gains, somebody coming from scratch can't really start with 100,000 in margin. So I'm sorry, with more than 100,000 margin, it's going to get 2 times margin. So I don't want to overdo the margin on these trades. So that's why I took a small position in IBM. But I didn't want to not have our trade of the year in. And by the way, we missed Apple. If anybody's wondering why Apple's not in this portfolio, we missed it. It's up 10%. It's up more than 10% from the bottom. And I'm not going to chase into it. Even as much as I love Apple, it's not appropriate. We just missed it timing wise. That's all. Otherwise, it would be here for sure. I don't know if I could have possibly banged the table more on Apple than I have been for the last month or so. So I said here we have plenty of room margin wise and everything else. So we're out of the IBM now. Notice that the trade, it's very conservative because IBM's at 133 now, and I'm taking the 120, 135 spread. Why? Because look at the way the trade works out. That spread nets out for $650. It requires $4,500 in margin, and it's going to return $7,500. That's 150% of the cash plus margin in profit in 2 years, 75% a year back on your cash and margin. That's good. and it's virtually a sure thing. I hate to say sure thing, but I mean, come on. We sold the 130 puts because we think IBM is undervalued. We sold but only 2 of them. So even if it does actually go lower, we don't mind rolling into a longer year and doubling down on the puts if we have to. We took the spread that's already in the money. Now, why didn't I take a more aggressive spread? Blah blah blah. Because I just want it to be a simple, nice trade, and it makes 1,000%. It makes 1,000% on cash. It's weird. I have to justify well, why do you only want to make 1,000%? I don't know. I think that's good. The members are so spoiled. That's the problem. That's why we need new members. We're gonna start doing a marketing drive the next quarter, and this is why we need new members, because I need people who aren't so spoiled and who actually go, wow, 75% a year on cash and margin, that's fantastic. Literally, somebody says that's all you're gonna get. So, that's just the way it rolls. Can't help it. But look, sometimes we go for it, sometimes we don't. But this portfolio, so every trade I go into, I say, how do I feel about it? So Alaskan Airlines, a very solid operator, had a bad reputation, but the bad reputation, and they bought Virgin. They bought Virgin's routes that Virgin America gave up, and not. Everybody loves Virgin America. That's why I liked it, though. Everybody loves Virgin America. They were fantastic, but they weren't making money the way they make. The money they were making in America wasn't worth it compared to what they were making in Europe. So Alaska Airlines, well, we'll take it. And from the way they got it and what they were saying at the time, I got the impression that they were aspiring to make Alaska more like Virgin, not to make Virgin more like Alaska. And I like that. So I thought Alaska's a really good operator, and if they can just up the quality a little bit, they'll turn themselves into a really nice airline. So anyway, I thought this was a very good solid floor when they were low back in February. Let's see if I can get a calendar for that. Oh, look, he's right there. Oh, I guess we talked about this last time. February. Oh, you can see February. Anyway, they were down around here. They were down around 60. And I just, from looking at the company and all that, I was like, that's got to be a floor for these guys. So we picked that up. And where the hell was I? Here. Okay. Anyway, so that was a good put to sell. My attitude is we'll build a trade into it if it goes lower, but I liked it where it was. And we were able to raise $4,100. So that was a good trade. Caterpillar was an offset to a bull call spread. In fact, it was this bull call spread, the TZAs. So in other words, we bought these TZA calls for $9,200. We sold Caterpillar and we sold that. So we actually had a net credit on the spread. So, and understand this is the interesting thing when you do this, because my puts are the Caterpillar puts. Normally, if I did TZA puts and TZA went lower, I would be losing money, right? Because of the market was stronger than I thought, and then I'd lose money on my TZA short puts. But that's not necessarily the best idea for a hedge. Why should I do that? Because what I want to do is I'm going to hedge my hedge by saying, look, I'm going to take the TZA bull call spread. I'm going to take a stock like Caterpillar, which I really, really would want to buy. I really would love to own Caterpillar at $100. That's a great price to them, and I would love to have that in my portfolio. So I offered to pay $100, and this was back in October 25th, which I can't imagine they were that much lower at the time. Oh, they were. Look at that. They were. I mean, not that much. They were down. They were at 115, but they looked awful. Which is why that was when the whole market was selling off. It wasn't really anything particularly they did, although they had a rough quarter and they forecast a rough time because of China. And I'm like, okay, good, that's fine. But it's not a reason to sell them from 160 to 115. If you're a long-term investor, and again, not a trader, if you're a long-term investor, you accept the fact that not every year is going to be a winner. Your company isn't going to every single quarter beat the last quarter. It doesn't make sense. It's not a thing. You know, if you back a home run hitter in baseball and he hits 50 home runs this season, he hits 55 next season, and you buy the guy as a baseball team, he hits 45 home runs next season, dump him. Okay, the guy hit an average of 50 home runs a season for 3 seasons. This season you bought him, he went from 55 to 45, but that doesn't mean he's a bad player. It doesn't even mean he had a bad season. 45 home runs is fantastic. But in the stock market, he gets dumped. Doesn't matter if he's 25 or 27 or 30. It's not about whether he's washed up. Nobody checks his medical report. Nobody sees what his swing looks like. Nobody analyzes why it happened. They say, no, it was less, so forget it. We're out of here. It's idiotic. It's not realistic. The only reason this happens is because, unfortunately, 90% of the people who play the market have zero business experience and apparently not much life experience either. They're like little children. They think that everything has to go up all the time. And if it doesn't, they'll go somewhere else where everything's going up. And that's the worst way to play, because the things that are going up already went up. They're more likely to go down. It's the things that go down that you want to get into. They're probably going to go back up at some point. And again, not always. You should probably pay attention to how sales are actually going and what the business looks like, which is what we did in October. And that's why we picked Caterpillar. I said, this is stupid. For all the ones I pick, we don't have that. We have 200 stocks. Well, we have probably 200 stocks we really basically buy on a regular basis. And so there's 5,000 stocks we don't buy on a regular basis. So, I look at lots of stocks that went really low in October, but Caterpillar to me was like a very obvious one that was way too low. So the stock's at 115 and I can sell the 100 puts for, I don't know, what was it, $8 at the time? $12. It was crazy. My net entry is $88. Why would I not sell that? I mean, really, if it wasn't for the margin and stuff, why would I not just take this portfolio? If it wasn't a margin issue, why wouldn't I sell 50 and get 12? Is it 12,000? No, wait, no. If I did 50, I would have gotten. Sorry, what's the number? Oh, 6,000. I'm sorry, I got 6,000. So I sold 50. I would have gotten $60,000. If you just sold 50 of those, and that's it for the year, and we'll make $60,000. Goodbye. And what's the worst thing that can happen to me? I own 5,000 shares of Caterpillar, which is $500,000. But I mean, that's I don't mind owning 5,000 shares of Caterpillar at $88. I think that's great. It's so crazy. You're going to pay me $12 because you're worried Caterpillar is going to go below 100 when it's going to go below 100 when it's at 115? You think it's going to go $30 lower? The people have no idea what the value of things are. And we take advantage of it. So it's a good story. It's not a bad story. That's why we're here. We're here to take advantage of those idiots. And there's so many idiots. It's just amazing. Anyway, so that's what we do. So we sell the put. So point being, we buy the TZA spread. We make the TZA spread free by selling the puts. And the thing is, it's not the risk of TZA going the wrong way because we only have a bull call spread in TZA. We can only lose $4,600 in net of the spread. The only risk we're taking is the risk of Caterpillar, where we took more than $4,600 for 100. So what's the risk of this spread? The risk has nothing to do with TZA. The risk is whether or not Caterpillar stays over 100. That's the play we made. It's incidental that for free, we picked up a $20,000 spread on TZA. But we paid nothing for it. In fact, we ended up with a net credit on the thing. That's hedging. That's hedging and hedging your hedges. And in a situation like this, it works out beyond perfectly. In fact, look, we even up on the TZA spread, and we're up on this. But now, situationally, I'm looking at the portfolio and saying, okay, first of all, let's think about the position. Think about where we are and what's happening. I can't do anything with this position again until April. These things expire in April. I won't be on the show again until about this time in April, which could be after they expire. I don't want to leave these things hanging. It's not a play. I'm not betting TZA is going to be at 15. It's a hedge. I'm hoping it won't be at 15. That's my bad outcome insurance. But I still want to hedge going forward. So what are we doing? We're moving the TZA spread. We're taking what's left in value, which is net $5,000. It's more than we started with. The net of the spread now is more money than we started with. So let's cash it in, right? It's no longer good to us because of the insurance through April isn't what we want anymore. So we're going to take more money off the table, quite a bit more money. I mean, this is a $4,600 net spread, and now it's $5,600 and something dollars, $5,660. So we're taking a profit off the table, and we're going to reinitialize a new TZA spread. Now, new TZA spread is where to go? Oh, so we closed the 40 TZAs, the short ones. Oh, and I'm sorry, we left the we closed the April 15 calls. We rolled the April 10 calls. Oh, we closed the short ones. I'm sorry, we closed out the short ones. So we're closing that spread, and we're rolling the bottom calls to a new spread. And it's 40 of the 2020, and now we're taking the 8-15. So what are we doing? Going further out in time, deeper in the money. We're going from 15 to 8. We're going way deeper in the money. And we have a $7 spread, not a $5 spread. So we've widened the spread, gone deeper in the money, gone further out in time. So in other words, we have a longer time of protection of insurance. And we've done all that for $3,400. And don't forget, we made a profit of $1,600 on the last round we got. Now, so eventually we might lose this money. But at the moment, no, we're not. At the moment, it's all gains. And why is it gains? Why did this work out so well? And it worked out so well because we're being the house. Being the house means we are selling more premium than we're buying. The only sure thing, and I know people say sure thing a lot, but it's a sure thing. It's a mathematical, scientific fact that options premium will expire worthless, not the price of the option, the premium value of the option will be zero on expiration day. So on 10/25, let's see what TZA was on 10/25. I just want you guys to understand this is not, it's not something you can't do. This is important. I mean, I want you to understand it's not a complicated portfolio. I'm not doing anything crazy or I don't have any superpowers or anything like that. I'm just being very logical in my selections based on the situation. So when did we start this trade? Was it October 25th? October 25th. So on October 25th, okay, call it 12. TZA was at 12. And the trade we took was we bought the $10 calls and we paid $230 for that, not a big premium. So we paid $230 for the $10 calls. We sold the $15 calls. So well, that's important. I doubt it was really at 12, but it was, so it was 11 something, whatever it was. But we paid very little premium, maybe 50 cents premium here, right? But we sold the $15 calls for $115, so we sold twice as much premium as we bought. And we know both of them will expire worthless. So if we sold twice as much premium as we bought, these will lose their value 50%, not 50%, twice as fast. These will lose their value twice as fast as these will, the premium value. So if the position is reasonable and we have $1.52 a position, That doesn't have any premium, the position. So the only premium on here is what's above 152, and that's now just about 40 cents in premium remaining. So this held a lot of its premium. This lost a lot of its premium. This is completely out of the money. And so half of this premium is gone already, while we still maintain 80% of our premium. That's how come it became a profitable trade. Even though we sold in dollar value less, that less lost money a lot faster than ours did. And again, even in this portfolio, this is completely suboptimal because I wasn't able to make a move when the market dropped. On December 26th, we flipped all our hedges bullish. We could have cashed this thing out when TZA was up here. I would have loved to have done that. I just didn't happen to be on TV then, so we didn't do it. I was really gung ho. I wanted to send a note to BNN, but it wasn't practical. They can't interrupt their show to adjust my portfolio. It's not the point of the exercise. So we just left it alone. So it went up in value, went down in value. But the thing is net, and that goes for both of these spreads because they're on the same principle. The net of these spreads, they're both positive, even though it hasn't really gone our way. It went our way and then it went the other way. Then it went against us again. So see if anybody has any questions or anything like that. Nope. Okay, good. Oh, Fed's coming up in a half hour. Look at that. Now, GE, bad trade. All right, we don't have many in this portfolio, but it was because I thought GE was a great bargain, and we sold puts in February. So I was on the show again in July. And I said, whoa, well, this went against this. I'm not sure how much at the time. GE. Oh, yeah, it's nasty. So between February and July, we had come down to 13. So it wasn't terrible. And I said, you know what, let's create a bull call spread, which is what I often do when I think a stock is still good. So we created a bull call spread, and unfortunately a fairly bullish one. I didn't really hedge it, because I really thought we'd go a lot higher. So that got killed. This got killed, the puts. That got killed, and we barely made any money here to catch up because we didn't sell enough. We only sold 10. So very aggressive trade, totally didn't work out. I mean, didn't work out by a mile because GE has since completely collapsed. And again, not optimal because I missed the window when it was way down. But in the GE trade, we've got a loss of $9,000. And what we're doing is we're taking that and we are, this is just today's post, by the way, so it's easy to find. So here we close, we're killing the short calls to be useless. We're rolling our puts to 2 times 20 puts at a lower strike, the 15 puts to the 12 puts, hopefully a realistic target. And we're rolling the 30 calls, we're salvaging $1,230 out of them to 30 spreads. And we're only spending net $1,870 to do this because we're rolling to more expensive puts. So we're only spending $1,870. And we had a loss at $49.90. And that lowers, and then the loss is lowered, blah, blah, blah. So anyway, so we can still, but in the bottom line though, is we still have an upside of, so our new position is basically minus $3,000. And if we collect the full $12,000, it's actually a turnaround of $15,000. All right, so we're currently net negative $49.90 from what we started with. And now we're spending $1,870 in cash, so that gets added to the $49.90 because it's an asset, because that's the value of the new position. So now the new position is minus $3,120, and we're going to collect hopefully $12,000. We can turn the entire position around if GE gets back over 15. That might be a tall call. I'm sorry, back over 12. So we've ratcheted down tremendously because we started off with a much higher strikes. We started off with the 13-18 spread. So now even if GE is below our original bottom target, we're still going to make money. That's the adjustment we're making on the spread. And anyway, we'll take a look at it. The MJ trade, we made a ton of money. That was the last time we did a trade. That's what Greg just said. The MJ trade went well. What do we got here? We got like 6,000 something profit. I probably wrote that somewhere. Oh, 65.50. So, I mean, just setting up this trades, again, the same thing I always do. I took a call, I took another call, we took both these calls, sold those puts. And at the time, which was October 25th, MJ, oh, that's funny. MJ was, oh no, here's October 25th. I thought that was October 20th. Okay, here's October 25th. So MJ was down here, so it barely moved. It went lower. And again, I wish I could have taken advantage. In the long-term portfolio, we took advantage. But down here, we thought it was holding up. It flattened, but it actually spiked down, went back up, and then went crash. But it's all, and again, why is it doing it? That's the thing. Why is it doing it? We happen to own PSW Investments owns 25% of a marijuana company in California. We're in the process of buying an interest in a hemp CBD. Not doesn't get you high, just the beneficial qualities of the marijuana plants. We're buying into a CBD company in Florida. Our California company is going to be opening new branches in Florida, Massachusetts, Michigan, a couple other places. We've raised a good amount of money for this stuff. So anyway, I was just at the marijuana conference like a week ago or 2 weeks ago, whatever the hell I was there. I don't remember. I just remember being at one. Anyway, so I'm heavy into this industry now, so I'm very paying a lot of attention to what's going on, and it's incredible. In fact, one of the things I said there, I was speaking at one of the events, and I said, look, basically what you're doing here is it's as if you're farming, and you're selling ears of corn for $50 an ear. And I was addressing people who are growers, so they're like, most of them have more experience in farming, regular farming than pot farming. So I'm like, you're just growing. It's not hard to grow corn. It just like grows everywhere. It's like you have to cut it down all the time. If you don't cut it down, it's going to keep growing. That's what pot's like too. It's a weed. It grows really fast, really often, and it will start spreading if you don't keep track of it. It's going to start spreading on you. And then everybody gets free stuff and you're out of business. Now it's to grow good pot takes skill. To grow bad pot is easy, as many of us know from high school. It's easy to get bad pot. It's hard to get good pot. And people are more sophisticated. So, but still, it really isn't. The profit margins on this stuff is unbelievable. The consumer demand is absolutely out there, and it's not just that, because I live in Florida now in Delray Beach, and I got to tell you, I mean, I live with the old folks. I love being down here. I'm like young. I'm young again. I'm in the lower band of like the ages here, but. It is, people get older, they have aches and pains, they have glaucoma, they have this and that, they have cataracts, they have joint pain. The medical marijuana does wonders for all those things. It's incredibly helpful. And people on chemotherapy, people who have kidney problems, it just is incredibly good for all those sorts of things, because it does a lot of stuff that helps your body's basic functions. A lot of your body's basic functions. There's something called an endocannabinoidal system or something like that. You can look it up. It's actually, there's a lot of stuff connected in your body that actually uses CBD to lubricate itself. And so when you use it, it dulls pain receptors and does all sorts of things. But anyway, I'm not going to evangelize it. It certainly seems to help a lot of people. Is the bottom line. Obviously haven't been any real good scientific studies. But a lot of indications point to, and anyway, personal things. I hear it all the time. I hear people constantly saying how much I like can't even live without it. And again, not the kind that gets you high, just the regular CBD, the stuff that just, you take it. It's just like taking any medicine. They take it and then they feel better. I mean, it's a very, very big industry, and it's growing and growing very fast. And it's so small right now compared to where it is. And then the projections I was hearing at the conference where people were looking at the U.S. Marijuana industry being somewhere in the neighborhood of $200 billion in a few years. $200 billion. It is currently about $10 billion. And so if you are in it, you have a very good chance of doing very, very well. And the whole point of this ETF is that this is just a basket of companies that are in it. And if you're in an ETF and you've got 10 companies and 2 of them become 10 baggers, just 2, that means that 20% of your holdings becomes 200% of your value. So you will have doubled. If 2 companies out of 10 become 10 baggers, your ETF will double. Very simple logic, right? We don't need to be hugely successful. And again, if the others can all go to 0 and you'll still be a double. If 2 of them become 10 baggers, if 3 of them become 10 baggers, huge. If the other ones don't go bankrupt, huge. There's many, many ways to win. The only way you can really lose is all 10 have to fail. If one of them becomes a 10 bagger, if one company out of 10 becomes a 10-time, moves up 10 times, then the entire ETF will be flat at worst, because 1/10 becomes 100% and the rest can be 0 and it wouldn't matter. So what's the trade we set up at the time? The trade we set up was very simply 25, 45, bull call spread, not looking for a huge movement. And we sold the 30 puts saying, I think that like I said, I think that it doesn't take much for this index to maintain its value, to at least stay where it is. You get huge premiums. The big advantage of this index was it got huge premiums because it doesn't seem volatile. It is volatile. It's incredibly volatile. Went from 25 to 40, back to 25, and back to now it's going back to 40 again. That's great. It's great for us because we sell premium, and there are people betting it's going to go to 50, and there are people betting it's going to go to 10, and we sell to both of those people and keep all the money. It's freaking great. I mean, there's not a more fun way to make money than this. It really is not. And so that again is an easy, obvious thing, and it's a sector. I wouldn't be surprised if this whole index is at 100, but I don't care. We're going to make what's the amount? The upside is 30. So the upside is $31,000. We're going to make 400% if it hits $45 in 2 years. And I'm sorry, that's the upside now. I said even as a new trade, because when we started, we didn't spend $8,500. We spent where is it? 19 minus 17,750. So we spent 1,250. So we started at 1,250. Now it's at 8,050. So it's already up 7,000 whatever dollars. So yes, it's up 6,550. Okay, so it's already up 6,550, which is already 500% of the $1,200 that we started with. But even now at $8,000, it's still going to make another $32,000. It's still a good trade. It isn't 1,000% trade anymore, but it's still a good trade. But this one, the ETF itself is going to be a 10 bagger for us, even though it doesn't move that much. That's the kind of leverage you can get off these option trades. You don't have to swing for the fences to make a fortune. All you got to do is grind these little wins out and make sensible leverage plays where you sell a lot of premium. It puts the advantages so much in your favor from the minute you start the trade that it's almost hard to lose. Look at GE. Look how wrong you have to be to lose money. Because if you start out with a reasonable amount and you can afford to adjust it, you're still going to make money. Unless, of course, the company just completely fizzles out to bankruptcy, like PCG just is doing, the utility company in California. Because, I mean, unfortunately, it had a catastrophic failing event. Their poor maintenance stuff and their overall negligence caused the first wildfires in California, cost tens of billions of dollars in damage. They're going to be in court for years for that stuff. And now another fire came, and they've been cleared of damages in this one, but it doesn't really matter because people are going to sue them anyway. And the company is going bankrupt. That's it. They're like, that's it. We're done. We can't do this. Not only that, though, but the cost of continuing as a company requires them to now go and get insurance. And to get insurance now, the insurance company is saying, are you freaking kidding me? Because the insurance company is also on the hook. That's another good chart to look at. Because the insurance company originally said, well, okay, so what's going to happen? A power line is going to fall on a house and going to kill somebody, and we pay $20 million and that's that. It's like that, like an accident happens or whatever. That's what they were thinking of when they're insuring this company. They weren't thinking you're going to burn down half of California. And it's a whole different equation for the insurance company when they go back to them now and want to renew their contract. The insurance is now going to be a fortune. They're going to say, I'm sorry, but we have to charge you $1 billion a year for insurance instead of $10 million a year you were paying. Because our potential liability is $30 billion. You could have a $30 billion accident. It's like a nuclear plant. It's like, that's a big cost of nuclear plant insurance. You could have a $30 billion accident. You can't pay $10 million insurance for that. You got to pay $1 billion insurance. And even then, there's not many guys who will touch you. It's, and it's funny to me because I read all these reports now. I even said to a reporter, I'm like, how come you don't talk about this? I said, nobody mentions this concept at all. It's like people are like, why are they going bankrupt? It's like, you're going bankrupt because you don't have that kind of money. I'm like, why is it? And guys said to me, people just don't understand it. It's too hard to explain, and we don't have the space or to explain, or the patience, and we don't want to answer all the calls in where people have questions. He's like, you just don't, so they skip it. It's too complicated, so they skip it. And therefore people are ignorant as to what's actually going on. It blows my mind. I mean, I don't understand the way things work. I don't understand the way things work as in how do people invest without knowing what's going on? How do you hold on to a stock when you actually don't understand how it works and how they make money and what their expenses are and so on and so forth? It's crazy. All right. So GIS, I like them. They're good and steady. They're on track. Gold is the old Barrick Gold, and they bought the company Gold. What is it, Rheingold? I don't know, whatever it was. I think it was Rheingold. Anyway, so they bought gold, and they like their symbol, so they kept that instead of ABX, which I like ABX, but that's fine. Just a good old reliable stock for me. LB, another one, basically losing money, but not too badly, but I like them, and we up that trade. MJ, the ETF we just talked about. Micron, I think, is also going to see better days. And in fact, today, are they really? No, they're not down today. Hang on. They can't be down today. Yeah, only up a bit. All right, so Micron, another one I like. And again, we're being fairly modest. We're at the strike, and it's positive. It's just very slow going. Wheat and precious metals, love it, and I think gold and silver are going to do well. And plus, we're super conservative on this one. Again, we're already at 20. We have 2 years to get to 22.50 to make the full whatever the hell on this trade. So that's good. And that's it. Not complicated, guys. And here's the thing. So when I'm analyzing these positions, you see what I do every time. I say, this is how much we're going to make. So what am I doing? I'm like, here's the net. The reason, we're at $105,000 in the portfolio. If I can't highlight this, we're at $105,000 in the portfolio. Why are we at 105? Because these are the net prices, and they add up to 19,000, and then we've got 85,000 in cash, right? So what's going to change in the portfolio? These net prices are going to change. How are they going to change? Well, if all goes well, I'm trying to think of the easy one. Okay, if all goes well on the marijuana ETF, on MJ, we have 20, 25, 45 spreads. So what am I going to make? I'm going to make 20 times 20, which is 2,000 times 20, is $40,000. That will be the net. This would expire worthless, and these will end up being $40,000. So the balance, my best case balance over here is going to be $40,000. Is it $40,000? No, it is not. It is 21 minus 13 is about $8,000. Okay, so that means my upside, I have 8,000. My current balance is $8,000. My upside is $32,000. That's how I calculate it. So how much money can I make on this position? I can make $32,000, which will increase what would that do? Before I cash in, it would increase the security values by $32,000. Now, looking at the position, these 45 calls are 100% premium. So there's 6650 that's going to be easy money. I know I'm going to get that back eventually. It doesn't matter what happens, this premium will expire. Even if the stock's in the money, even if we're at 55 or 105, it doesn't matter. There still won't be any premium left on apparently January 15th of 2021. Okay, so on January 15th, 2021, these will expire, and this will be worthless. This 6650 will come in. This will come into my pocket no matter what if I hold this position. These will be worth what they're worth. So it depends what happens, but they'll be worth what they're worth. But then over 45, I then have to pay these guys what they're worth, and that would cancel each other out. So up to 45, I make as much as $20. So anything over 45, I still make the same 20 net of the spread. And the short puts also, they're 100% premium. I will collect this money. This money will go in my pocket. There's $13,300 I will collect by simply sitting on the spread. Now, I may have to give some of it back if he's in the money. I may have to give some of it back if he's in the money, but I will collect $13,300. It will be in my pocket. And I can then adjust the position and not pay them back. That's why this system works. It's only net $8,000 right now, and I know for a fact I'm going to collect $13,000. Now, yes, some of the money I have is a premium. My calls are $8 in the money, and they are currently $10.50. So $250 of that is premium, and $250 times that is $5,000. So I have $13,000 here, but $5,000 of my premium will burn off and be worthless. It's a fact. So that still nets $8,000. I have an $8,000 spread that for an absolute fact will pay me $8,000 in premium that I've sold over the course of the next 2 years. That's the one thing I know for sure is that that's going to happen. The rest is a guess. I'm guessing that the marijuana ETF will do well. It should be at 45. I doubt it goes below 30. If I'm right on those guesses, I already have an $8,000 advantage going into it. If I'm wrong on those guesses, I still have $8,000 to play with to fix my position. That's why the system works. I've got 100% of my net trade, and don't forget that's net of already making these gains. I have 100% of my net trade. I initially put in $1,200, so I have 500%, 600% of my net initial cost already locked in. I'm going to get that profit back. That's going to be my money. Then I can adjust the trade after that using that money. And as you can see with GE, we've spent very little money on the GE trade to make a very big adjustment. If you know what you're doing, if you understand how to move these things and how to use them to your advantage, how to take a position that's lost its premium like GE, because what I do, these 18 calls, right? No, sorry, puts. The $15 puts are now $6. GE's at 9. Well, 15 minus 9 is 6. They have no premium left. At one time they had premium. I sold them for $195. I don't know if it was all premium, but at one time I had premium. That's been to my advantage because thank God I collected that premium that offset my total losses. So it's minus 61.25 now, but I only lost $4,000 because the rest was premium. So what am I doing to fix it? I'm rolling it to the 2013 to the 13 puts. And I'm rolling it, and those things are, I forgot the number now. Maybe the 12s, I don't remember what it was. We're rolling into the 2021 12 puts at 380, so let's say $4. So those in that 8, they're $4. GE's at 9. So what have I effectively done? I've sold $1 of premium times 20 in the new spread. So I sold $2,000 of new premium in the puts. I was down 4,000. Now I sold 2,000 more premium that I will absolutely collect. So now I've taken half that money back. Now I've lowered the bar from 15 to 12. And if GE can make it back to 12, the whole thing is worthless. And I gain net 61.25. You know, plus the additional money for the roll I'm doing. So yeah, bad loss at the moment, $4,000 loss, very annoying, but it's fixable. And the reason it's fixable, for one thing, is because I don't really mind if I own $15,000 worth of GE. Of course, I'd rather not own $15,000 worth of GE when it's at 890 and down that much. But what would I do if I did own $15,000 worth of GE? What would I do? I'd double down at 9. And then I would have 15,000 here plus 9,000 here would be 26,000, and I would net in at $13, right? So what's my worst case by selling the $12 puts? My worst case on the $12 puts is I'm going to net in at $8. That's fine. I don't mind that. It's actually better than if I got assigned the stock and double down. Not only that, but originally I said I was going to commit $15. So I was going to commit $15,000 to owning GE here. How much am I committing now if it goes below 12? I'm committing $24,000. That's not that much more than $15,000. I mean, it's 8,000 more. It's about half, about 50% more. So I'm getting double the amount of shares for 50% more money. And if it goes down to 6, I can do the same thing again, and I can drop my basis down to I don't know, whatever, $7, let's say. And then I would own 4,000 shares at $7, which is $28,000. So at that point, I've doubled my commitment to owning GE stock in dollars, but now I've got 4,000 shares instead of the 1,000 shares I thought I was going to get. So when GE was at 15. If you said, would you like to own 4,000 shares at 7? I would have said, oh, yes, I would. Where can I get that, please? And it turns out where I could get it was by starting here, by selling the $15 puts. Oh, here comes the Fed. All right, got a couple of questions. We'll get to those after the Fed. Fed rate decision imminent. It's gonna be a hold. All right, let's see what kind of silly reaction we get out of the stocks. Here's the indexes, and the Fed's going to say we're doing nothing. Well, the Dow is now only up 250. It was up like 400 at one point. Oh, the TV people are laughing. It is 159 still technically. Hang on. Oh, here it comes. I think they already know, though. I think they already have it. And they're just unchanged. Oh, stunning. Look at the market. So the official rate is 2.25 to 2.5%. So in that range. They will make changes if necessary. Muted inflationary pressures. There will be some further gradual increases, so they're still on that bandwagon. But they're patient. All right, we'll look at the statement, but there's nothing. There's nothing. It's the same thing they've been saying, and there's nothing. Look at that freaking spike. I don't know. What did they expect to happen? It's exactly what we knew was going to happen. Why would you have that kind of reaction? It's crazy. Oh, I love the market. So funny. Look at gold. Gold's going down. Oh, yes, because now, where's the dollar? Dollar down to the dollar, because that's a weak statement. That is a dollar weakening statement. The Fed is going to continue with an easy money policy for a very long period of time. And that's no reason for the dollar to be strong. So gold is up, silver is up. That's good for wheat and precious metal, who's on that sheet. It's good for Barrick Gold, who's on that sheet. So let's answer a couple of questions. I honestly, there's nothing in that statement that's worth reading. I mean, we can take a look after, but it's not even worth the time. Let me do the questions first, and we'll take a look back at the Fed. Apple, can you review your trading plan on the 2021 $120 long calls? Is there a point where you're looking to cover? Oh yeah, sure, of course. I think it's seven. Wait, I think the number is 178. I think the bounce line. I think it's an 18-point bounce line, so it's 178, and then 18 more than 178 is 196. That doesn't seem right. 168. I'm sorry, it's 168. Sorry, it's 50. It was 18 points from 150, so it's 168 is the weak bounce. And above the weak bounce is going to be 186, which is way up here. Not 176. I think I said that before. 18 points higher than 168 is the next bounce line. It's a strong bounce. Don't forget, we fell from here. Big difference, right? We fell from way up here, and now we're down here, and this is weak, and another one like that is going to be strong. But it's going to be 180 and 186, basically. That's going to be about there. That's a strong bounce, 40% from the top. So the question is, will we cover? I'm not going to cover here. I certainly expect, and again, oh, well, let's talk about that. That's important. All right, hang on. Here we go. Let's use this. Ooh, I'm going to do something fun. Can I do that? Home. Okay, cool. All right, let's do this. Let's first of all get Apple up. Otherwise, there's really no point. Okay, now watch this. So Apple fell from, let's see if we can make it bigger. Bigger. How about 1280? Update. All right, that's a good size chart. Oh, I wanted to annotate though. Okay, can I annotate that? Yes, I can. Look at that. All right. So from 230 to, I believe, 150, I decided that 150 was where we found support. Also, let's remember that Apple did their big reverse split when they were at 700. They did a 7-for-1 split. So the baseline for Apple post-split is the $100 line. So 150 is 50% up from Apple. That makes it a strong contender in the 5% rule, more so than just eyeballing things. When you really want to figure out where a stock should be, you have to look back at where it was and think about the 100% gain, the 50% gain, the 200% gain. So 100 was 100% gain, 150 is a 50% gain, 200 was 100% gain of Apple from post-split. And if it went to 200, On the 5% rule, you got a 100-point move, and a 20% overshoot takes you to 220. See the consolidation here? And then it failed. And then it didn't fail, then it retraced. Let's call it that. But it did retrace a lot, it retraced half. It overshot on the retrace. How much is an overshoot on the retrace? It falls from 200, forget everything else. It falls from 200. Now, this is an overshoot, and it corrects. 200 is where you should have been. 200 is where it should have patiently consolidated, but it didn't. It should have really just gone around here like this, and it would have been a lot healthier. Instead, it overshot and then fell back. But if we assume 200 is the with 100% gain, now you say, well, 100 is 200, obviously 100 points. That means you've got a 20-point weak retrace to 180, another 20 points to 160. And that's where, see how the 50 DMA is right there? That's your strong retracement of the 100-point run that Apple's been on since it split. This, another 20 points down, is an overshoot. And if Apple had fallen all the way down to 100, this would be the strong bounce line. The same thing. The 140 line would be the strong bounce line. So it's very unlikely the 140 line gets broken. But where should we really be? 150 should be the baseline. Okay, a 50% gain should be the baseline. From there, we do our calculation. So 230, you still calculate the whole fall. 230, but actually explaining another trick. So 230 to 150 is 80 points. Oh wait, it's 80 points. So there's 16-point bounces. I'm wrong. I got mixed up on that somewhere. It's a 16-point bounce because it's an 80-point drop, so a 16-point drop bounce. That means 166 is the weak bounce. 20% of the drop is your weak bounce. 166 plus whatever, so 182 up here is your strong bounce line. And you know what? By the time it gets to there, it'll probably be the 200-day moving average. The 200-day moving average will fall down over the next month, and this will go up. The 50-day will start turning back up, and you'll get across of the 50 back over the 200 there, and that'll be a big bullish sign, and that's when Apple can explode higher for whatever reason seems to work at the time. And I'm just telling you what's going to happen. So I can tell you now. Now, here's the Fibonacci thing, and I'll show you how that works. You do Fibonacci retracement, and we can go from 230 down to 150. And now you can see what the Fibonacci lines look like. All right, so Fibonacci and the 5% rule, not that dissimilar. You're going to be at the same 180, basically. So you're looking to retake that spot on the Fibonacci chart, and from there, that's what you would expect. And look how it abated all the way down. Look how you have a gap here, down to here, consolidation, gap down to the next level here, fall to there. Okay, it's all very, very predictable, and it's because it's all basically being traded by computers. So they're just going to do what they're programmed to do. These are natural movements in a stock. It seems horrible and violent, especially if you were the suckers who bought at 230. But we've never been those suckers. We cashed everything out when it was up here. You know, when Apple hit it, my target to sell was 204. That was $1 billion for Apple, 204. I said 204 out. I'm not billion, trillion. At $1 trillion, I said that's enough, and we cleared out our Apple trades. When it got back down here, we jumped back in. I think around 160 we started buying again. Not 160, maybe 180. I think 180 we started buying some. I don't remember. But the point is, you know, this was stupid. And you have to know, even if you love a stock, it's my favorite stock on the planet. Has been for 15 years now. Even if you love a stock, you still have to know when it's overpriced. You still have to know when it's too good. You know, like my brother is a really good singer. He's really good. In fact, he's playing with the guy who came in second, the comedian from America's Got Talent like a year ago, the guy who lost to the Dogs. My brother and him are doing a show Saturday. My brother's the opening act for him. My brother's a really good singer, but would I tell my brother, and would I tell my brother, you got to go on America's Got Talent, you're going to win, blah, blah, blah. No, he's not the best singer in America. He's not, he's very good. He's talented enough to do a show and get paid for it, but he's not a superstar. And I love my brother. I think his voice is great. I like watching him sing, but you got to be realistic about what someone is. I'm not going to sit there and then tell him to go through all the stress and strain of doing something like that. And it's not because I have a lack of faith. It's because I'm realistic. And the same thing for stocks. It doesn't matter how much you love the stock, how great you think it is or whatever, you still have to have some realistic concept of what it's worth. And Apple's not worth $230, which is basically $1.1 trillion. It's too much. It's almost $1.2 trillion at that price. That's too much. Why would Apple add $200 billion in market cap above the 1 trillion mark in weeks? What did they do this month that added $200 billion to their market cap? I said that at the time. Nothing. Of course, nothing. There is nothing you can do to generate $200 billion in market cap. You got to realize how big Apple is. A little tiny company can go up 10%. It's not a big deal. It's not like it only takes one or two guys saying they believe in them. But for Apple to maintain, gaining 10%. It only matters what the last sucker bought your stock for on any given day. Whatever the last person paid for your stock, that's where the stock's going to finish for the day. So you can find a string of suckers here to pay up, right? But to maintain that price, now you have to every single day find people who are willing to pay $1.2 trillion for Apple. And they have to, and every day, whatever the turnover percentage is, let's say Apple turns over 1% of its stock a day. Every day you have to find 10%, wait, I'm sorry, 1% per day would be $12 billion. Every day you have to find $12 billion worth of buyers of Apple stock just to maintain this price. And yes, you can have $12 billion worth of idiots for a month coming in and buying Apple. But even if they do it for 20 days, they've only spent $240 billion. They've accumulated 20% of Apple's stock over the course of time. And they paid top dollar. And then when Apple starts going down, those guys start freaking out. And you can see them selling and panicking and selling and panicking. And you can see how red everything gets. Okay? Everything was normal. They were selling, they was buying, they were selling, they was buying. All of a sudden, buy. And then, oh my God, what idiots we were. That's what happened. That's when Google once said Schmidt, he said the law of large numbers, and that's what the law of large numbers is. There aren't that many people who are going to buy $12 billion worth of Apple stock at that valuation. Yeah, are there some people? Yes, because Lincoln said you can fool some of the people all the time. There is always going to be some people who will pay stupid prices for things. There are always going to be some people who will sell even though something is a tremendous value. It's the same principle. People will panic out at a ridiculous price. People will jump in at a ridiculous price. There are two sets of idiots. Try not to be either one of those idiots. That's all. Then you'll be a good trader. Now, remember I said that there's another thing you can do, which is also you look at the, we still want to be at the 150 line. Let's look at the 200 line, which is where we should be. Not where we are, but where we should be. And again, look how suddenly things line up. Apple should have gone, my premise, Apple should have stopped to 200. Look how we were baying in this zone too. Also, very clearly, consolidation, big drop when you fail that line, big drop, no support whatsoever. Now we find a bit of support around that line, and we're heading back up to test that level. So from 200, the strong bounce line is about 170. And and then you see how this 60% line, and so they also agreeing with Fibonacci 182. So our 5% rule says 172, 170, wait. Says, I'm sorry, it says 166 and 182. And we're at, I mean, amazingly, that's right where we are here, right? We're going to be at 166. The next stop is going to be 182, where we agree with Fibonacci. So there's multiple confirmations that line up at the same place for us. And that's how we figure out these lines. That's where it comes from. You know, I look at these things and we calculate it. The 5% rule. I want to clear this. Delete. The 5% rule is mostly, let's go back to the other chart. It's mostly math, but it's also art, because I have to say, like I said, this is where they split. So I think that's the base. $700 is where they split. They split 7 for 1. They ended up at $100 stock. It was at 700 for a good amount of time, consolidated. That's a good line. So from that line is where I'm basing Apple off of. Here's the $50 move. Here's the retracement. What did it do? It went to 150, little tiny overshoot, retraces back to 140, which is what? The 20% pullback from 150. $50 move up, $10 move back. Little consolidation, another move up, another pullback, a bigger move up, and now we're clearly staying above 150. Come back and test the 150 line from this side now. Come back and test the 150 line from this side now, and clearly it's off to the races, working its way up to that double. Then it went crazy. But that was stupid. And you can see by how far it goes over the 200-day moving average. Look at it here. Too far over the, it's 40 weeks. Too far over the 200-day moving average, and it pulls back and consolidates along the 200-day moving average. Too far over the 200-day moving average, so far over that the whole thing collapses, and now it's going to consolidate back on the declining 200-day moving average. Where are we going to end up, though? We're still going to end up consolidating back at 204, the $1 trillion mark for Apple. Okay, although, let's see, if they buy back shares, they have less shares, and that means a higher price is $1 trillion. Aha! So you have to watch the share count. Okay, so think about that. If they have 100 shares, and to get to $2 a share, to get to $200, if there's only 100 shares outstanding, to get to $1 trillion, well, okay, it's not as easy as I thought. It's not as easy to explain as I thought. All right. Oh, why is it so hard? Anyway, let's forget Apple and the trillion. To get to, if a company has 100 shares and they are at $100 a share, that's $10,000, right? So that's a $10,000 valuation. What happens if the company buys back 10% of its shares? Now they have 90 shares, and to get to the same $100,000 valuation, they now have to be priced at $111. Get it? So the thing that matters is the $1 trillion valuation, not the actual dollar amount of the shares. So when I did my calculations, it was 204, but that was where $1 trillion is. So what I'm saying is the 204 could change because Apple keeps buying back their shares. And we're going to have to recalculate what $1 trillion valuation is for Apple. And that's where the line's going to be, though. So that's what we can expect. Meanwhile, point being, though, it'll be significantly higher. So Apple can go significantly higher than 200, and that will be the new consolidation for $1 trillion. See, it's interesting. You've always got to watch that stuff. So variables change. This is very important to understand. You assume static variables because, unfortunately, that's how we basically were grown up. But variables constantly change. You have to be very aware of what your variables are and if they can change. So you assume something is going to be normal, like, oh, well, $1 trillion is 204. But then you think about it and say, well, only if they keep the same amount of shares And Apple's not the kind of company that keeps the same amount of shares. They're buying back like crazy. Anyway, so that's where we are in Apple. So I'm sorry. So you were right. It's not really right. Wait, no, somehow it's wrong. You're wrong, but right. It's 150. No, 166 and 182. The 182 is correct. This one should be 166. So I sold 7 FTR January 8 puts. This is Todd at 386. Currently, there's no premium. Right, that's true. FTR January 8 puts. So let's take a look where FTR is now. FTR. Oh, look at it down now. It's at 450. Holy crap. Oh, I guess they decided they were happy with those Fed notes. All right. So I'm sorry, you said January. Wait, I don't know what January you're talking about because obviously this January expired. Let's try it again. He sold anyway. He sold 7 January. All right, so you sold 7 puts, the 8 puts for $4, and now we're 2. So basically, whatever happened to them, if you sold these January, it wouldn't matter. They're at 6 because the stock's at 2 and there's no premium. The problem is, look how wide these spreads are. The problem is it's hard to say how much the real prices are for these things. Can you sell the $3 puts for $1.60? I don't know. I don't know if that's a realistic price or not. If it is, it's a pretty good price because then you're netting in for 140. So I would like that. If you can sell that, you would have to sell. Well, okay, let's say it's 150, argument's sake. So let's say it's 150 and you're netting in for 150. And these are 6, because this is a math. So 4 times as many. If you do that, you'll have an even roll from the 8s to the 3s. Your net cost is going to be 12. Okay, so instead it'll be 12 there. It would have been 8 here, but now you're getting, so instead of 1 8, you're getting 4 3. So your cost is going up 50%. You sold it for $4, so that's good because basically what that does is it means you're basically knocking $1 off the net entry of all of these. So you're really going to enter for 2. But your net would have been 4, the other way also. So but the thing is, in this case, you're not doubling down, you're quadrupling down, and you're going to end up at net 2. So you'll spend only twice as much money to have 4 times more shares. That's a call you got to make, whether that's worth it to you. You're at 2 now, so you're just basically being bullish from here. Since it's a no-cost roll, you stand to make the same money that you sold the thing for. You're going to make the $4 that you sold the original shares for. But you would have 28. You had 7, so you would have 28 short $3 puts. Your worst case scenario would be assigned 28 at 3, which is, I didn't even want to do the math on that, so let's get a calculator. So you would have 2800 times $3, $8,400, but you sold $2,800, so 8,400 minus 28 that you sold the original puts for, you'd be in for 5,600 divided by 4,000 shares. No, I'm sorry, not divided by 4,000, divided by 2,800 shares. Now I forgot the number. Damn it. I'm so frustrated. All right. The $3 things, you can sell 28 of those. 28 times $3, 8,400 minus 2,800 you collected is 56. Thank you. Divided by 4,000 shares. $5,600. No, that's what I did wrong before. It's not 4,000 shares. It's 2,800 shares. $2 a share. Okay. So for $5,600, you're in for $2 a share. If you leave it alone, you'll be in for 7 times 4 is 28. So right now you are going to own $2,800 worth of FTR, and you're going to be at a loss of 50% of that basically, because your 7 shares are worth $1,400. If you risk being assigned $5,600 worth of FTR by moving to the $3 puts, then you're currently down $2,800. The same $2,800, you're down 28 times a dollar, and you just have a bit of a better target to hopefully catch up even. I mean, I would almost want to say wait till earnings, because I'd rather have more information. But if it's not a big number for you and you don't mind the risk, I'd do it now rather than later, because what if it pops to 3? If it pops to 3, you'd be on track to be even, but if it pops to 3 and you don't have the shares, then you're screwed. Now on the way down, you're not particularly more screwed than you are now. If it drops $1, you're going to lose $2,800 versus 14. So your risk in doubling down now is $1,400, because you understand you can't. If it goes down and you have 2,800 shares, you're going to lose $2,800. If it went down. If you went down $700, it'd be $700. Sorry, so your risk is an additional $2,100 potential loss if FTR goes down to 1. You would lose $2,100 more, versus the possibility of actually coming out even if it goes $1 up. So whereas going $1 up from where you are now wouldn't help you at all. So I would lean towards doing it, but obviously it depends how much $2,800 means to you. That's also, if it's money that matters to you, then no, I'd certainly wait for more information before making any changes. Sanjay says, Phil, what's your opinion about UNG? The problem with UNG is it decays over time, and the longer you give it, the more it decays. So why does it decay? It decays because UNG is constantly rolling. What they hold is the futures contracts. The problem is, though, if you hold the front month futures contracts, and they generally, I think, own the front 3 months, they divide it up. Every time you roll from one futures contract to the next, you're paying a premium. And they're not very expensive contracts. So in other words, look at NG. Well, yeah. Oh, yeah, here you go. Okay. So NGH19 is 285, and NGJ19 is 281, 263. Oh, here's the gap. Here's where you run into trouble. So it could seem fine for a couple of months, but then what happens? At the end of November, what? Why is it 2021? It's so wacky. All right. The problem is these things are all over the place. July 2019, May 2019. Oh, I see. You got to look at the 19s and not the 20s. Sorry. 281, 281, 290. Okay, so here's a rollover that wouldn't matter. 280 goes to 281. You see the Aprils go to May, 281. No big deal, right? But May, at the moment, there is no June. I don't know if there will be. I guess I'm not sure. I imagine there will be a June at some point. But even so, the bottom line is at some point, May rolling to July costs you 10 cents. So when you have to close the May contract and open the July contract, you have to close these for 280 and buy those for 290. That's your rollover cost. If your rollover cost is 10 cents divided by 280, that's 3.5%. It doesn't happen every month, but if it did happen 12 times a year, that would cost you 42% of your money just rolling your contracts. See where the problem is in the ETF? the more you leave it in, even like I said, that's obviously I wouldn't want to say it's a worst case. It could be much worse, but generally you're going to pay a nickel or a dime, and since it's a very low price contract with a very big spread, because oil's $65 and you have a 20-cent rollover. Okay, that's like 0.3%. Here you're paying 3.5%. That's when you get this relentless, horrible decay of your ETF. The ETF is going to lose value because it's shelling out fees like a maniac all the time. It's churning an account for you. That's what it's doing. So that's why long-term plays on that are not really good, because it'll tend to underperform the underlying instrument, is the best way to put it. So that's why I don't like that. Phil. So I prefer to buy like CHK or something like that, because they are the producers of natural gas. They aren't playing the market. They actually own the natural gas, sell it for a profit, and if natural gas goes higher, they make more money. That's the way I like to play, to have a company that actually makes money. Feel the same way about gold miners too. Same thing. I don't want to buy the GLD ETF. I want to buy gold miners, because Barrick Gold has 100 million ounces of gold in the ground, or not anymore. I mean, they sold a lot of their mines, but they got 70 million ounces of the gold in the ground, whatever it is now. Well, now they bought the other guys, so they're probably back to 100 million. Anyway, I don't know why I let myself get sidetracked by facts. Anyway, so they've got 100 million ounces of gold in the ground again, and so if that gold gets more valuable, then they're going to get more valuable. It's the net cost of how much they pull it out of the ground versus how much they sell it for in the open market. So they are a hedge fund for gold, but they actually physically own it. Unlike almost any other instrument you would play for gold, they actually own the gold. It's their gold. They just haven't gotten it out of the ground yet, but it's still theirs. Soma says, I'm opening trades at different times in the portfolio. What is the best way to adjust hedges along the way? I think when you have a day like this where the market's up like 1.5% or one, it's a good 1% move. You look at the change in the value of your portfolio. How much did it go up today in a 1% up day? Then you know how much did it go down in a 1% down day. From that, not your whole portfolio. Like, how much money did I make today? It was a 1% up day. I made this much. You should be writing these things down. Forget the deltas and bullshit that they do in the trade. Your broker probably has some kind of net delta, blah 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 account crap. It's all bullshit. How much money do you actually make? Because those things don't know how your positions are working. They only know hypothetically what might happen given the math of the thing. But that's not what actually happens in real world situations. In real world situations, some stocks get bid up, some get bid down, whatever. They don't all move in lockstep. And that's the problem, is the computer programs are fairly simplistic and only assume things are all going to basically move in lockstep. What actually happens is what matters. So what you need to do is analyze your portfolio on a daily basis so that you know how much of a hit you're going to take on a 10% market drop. You have a pretty good idea. But if you're a premium seller like we are, it'll be worse on a 10% market drop, because what happens when there's a 10% market drop? And again, you have to understand the mechanics of what you're doing. When the market drops 10%, the VIX goes up. People panic. The VIX going up makes all put and call contracts have more premium. If you are a seller of premium, that means you're going to take a vicious hit. That's why sometimes the long-term portfolio or the short-term portfolio might go up and down 10% in a day, even though the market only makes a 2% move. But that's because we sold a lot of premium and it's hurting us at the time. But you have to know that, because when you look at your portfolio, you have to understand this is why my portfolio is down 10%. Not because I did something wrong, not because I'm overhedged or underhedged or whatever. It's because the VIX went up and I can see that all these options that I sold have a higher price. And that's not going to last, most likely. And therefore, I just sit back and relax and wait for it to calm down before I change anything. And I do that all the time. I'm always telling you guys, I'm like, this is let it pass, let it finish off, let's see where we are in a couple of days. You can't automatically jump in and panic because you can ruin your portfolio making adjustments that aren't necessary. Anyway, once you have a good handle on how much money you're going to lose in a 10%, if you wake up tomorrow and the market's down 10%, where are you going to be? And if your portfolio is going to drop from $100,000 to $80,000, that's going to limit your options of what you can do. You could liquidate and be down 20%. You can do this and that. But what if you have a hedge that pays you $10,000 when the market's down when your portfolio is down to $20,000? Then you've mitigated half the damage. Not only that, though, but if you think about it, if your portfolio is worth $80,000 and your hedge is worth $10,000, right? Now you have $90,000, but the market's down at $90,000. The market went down 10%. It's at $90,000. So what have you done? You stayed even with the market. You can, if you change your stuff now, and if you buy and sell things and move positions to something you think is better, you don't have any friction costs because you've kept up with the market. So even though you lost more than the market lost, the hedge keeps you in the right position so that you can now reshuffle things without losing money. You can sell the hedge, do this, move that, whatever. You still basically have $90,000 in the markets, and you can buy the same shares you could have bought when the market was 10% higher. So that's what you want to do. You want to have a hedge that's going to mitigate the damage, usually about half, depending how bullish you are. If you're bearish, maybe you want to mitigate more than half. Like when we were more bearish in the fall, right before the market crashed, we were layering on those hedges pretty heavily. We had some big freaking hedges. We had 200 TZA something or others. Why do we have that? Because the market went up and up and up, and we kept adding and adding and adding hedges on the way up. Why do we do that? Because we were making plenty of money on the long side. So we took a portion of the money we were making, which is only paper profits, and boy, did it go away fast when the market dropped. But they're paper profits, but you got to take a percentage of those paper profits and put them into real hedges to lock in your gains. So it's a laddering thing. You do it along the way. You add more longs, you add more hedges. You add more longs, you add more hedges. Okay? You keep a balance, but not go overboard. Don't overhedge. Okay? You just try to hedge a reasonable amount what you think is going to mitigate about half the damage on the way down. Unless you're in what you think is a very toppy market, then you can add more hedges, and then you mitigate 100% of a 20% drop. But just realize, though, that if you're wrong about the drop, you are burning money. It's insurance. It's like life insurance. It's like saying, like normally you have a $1 million policy, but you're going to go skiing for the weekend, so you bump your policy up to $2 million because you think you might fall off a cliff. So you pay a little extra for the weekend, and it's $2 million. Then you come back. Now, if you keep paying the extra money for a $2 million policy that's not necessary, you're draining your current money for insurance you don't need. That's a bad idea, right? It's the same thing. That's all this is. It's insurance. You need to have the right amount of insurance, not a crazy amount of insurance. You're not supposed to win the lottery with your hedges. Your hedges are to mitigate damages. It's like car insurance. It doesn't, if you bang up your Toyota, you don't get a Porsche. They give you back a Toyota. Okay, probably your Toyota, unless it's totaled, you're going to get your Toyota back fixed, but it's not as good anymore as it is. It got hit and it's got a dent in it, and it's fixed, but it's something not quite right about it. Tough. That's what you got. But the point was to mitigate the damage, not to return a better car or a new car or anything like that. All right, that's what this is. It's insurance. Always keep that in mind. Byrne says, market taking off. Yep. Please tell me about your view about CMG. Oh, that's tough. We are, that's a trade that's hurting us in our hedge fund. We thought they would top out about $500, and that has not happened. Where is it? And it's a typical thing we did. It's not terrible, but it's annoying. I don't like to lose on anything. Look at this. So I think around here we sold the $500 call, on the way back up because we played it very well. We had cashed out our longs when they hit 500 the first time, and then they went down, and then we bought more down here, and then it went up, and then we decided to cover it $500. We have a long-term spread, and then we sold some short-term calls. Those calls burned us badly. Then they came back down, and now they're drifting. I still think that I think this is just unrealistic. I don't see how it's going to sustain this level. So we're still on them. We're just going to roll them. So we'll go from the 500s to the 510s to the 520s to the 530s, and eventually we hope it'll run out of steam. We'll see. But I think that also, though, and I had this discussion with Doug, who runs the fund. Also, though, I don't want to double down or anything like that, because you have to realize that at one time this was a $700 stock. They're capable of making that kind of money. I just don't think they're going to do it yet. And where's my charty thing? Here we go. All right. So you got to realize where this company is. And I love CMG when they're down around 350. I don't trust them at 500. They're at $15 billion at whatever they're at now, 530. They used to make $450 million a year on 4.5 billion in sales. Now they're making 250, maybe next year 350 in sales. $300 million into 14 billion is like a 45 times earnings. So even if they hit this, obviously they're going to hit that number. That's the most recent estimate. So they're going to hit 238 this year. Even if they go up next year, make whatever that is, it's a lot more. That's not nothing. It's 100 million more. So next year they're going to have a 40% improvement in bottom line profit. Can they? Sure, they can. They used to drop 10% to the bottom line. Now they're dropping less. They got to work on that, don't they? But I'm not saying they won't get back to dropping 10% in the bottom line, because you look at other restaurants and say, well, yeah, they can drop 10% to the bottom line. You always have to be careful comparing restaurants, because if you go to McDonald's, you're comparing a franchise to a company-owned store. That's not a good comparison. To make sure you're comparing the same kind of restaurant with the same growth trends and so on and so forth. But anyway, point being that your PE, well, there it is, it's 44. Your PE is 45. I'm not paying 45 times earnings for a freaking restaurant. Not one they've already expanded. Okay, they're not going to double the amount of stores or anything like that. They will improve their earnings, and I think that eventually it'll get more reasonable just based on that, but not this year and not next year. It's going to be a long time before they're making even 30 times. They have to make $500 million. They have to double this year's earnings. That's not a finger snappy sort of thing. It's going to take them years to get back to that kind of number. So I like Chipotle, but I just don't see them being worth $15 billion. It's a little bit much. They're going to have earnings. I don't know when. I'll be surprised if they justify this number. I just think it's really a little bit overly optimistic. Their current PE is 80. I mean, it's just ridiculous. Earnings at 2.6. We'll have to see. So like I said, we're covered. We have a spread. We're fine. We're not worried about it. We're like only sold about a quarter of what we have. But I don't want to roll to double and have a 50% coverage on our long spread, because that would make me nervous. I would rather take a loss and wait and see when it stops going up. But we are, holding on through earnings, and we're going to see what earnings are before we make any major adjustments. Apple buying 3% of their shares per quarter. Yeah, that's an incredible amount. Now, Naomi says, and I got to wrap this thing up shortly too, because I got to do that interview. Dow 25,000. Woo-hoo! Come on, everybody. Oh, Powell's talking. I forgot about him. Powell says the U.S. economy is in a good place. Wow, look at that. Wow. Okay, look at the VIX. The VIX is collapsing. Here's my VIX. Haha, look at that. That's a good speech by Powell. See? Good speech. And he's done speaking. He's just doing Q&A now. I forgot all about that. Sorry. Anyway, that's not important. I mean, obviously the markets are happy, so that's all we really worry about. Charts. Holy crap! Wow, are they happy? Look at that. Oh. Dun, 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 dun. Okay, everything's great. Couldn't be better. Look at gold. Gold is soaring because the dollar's collapsing. Look, the dollar's at half a point. So half a point of this excitement is from the dollar. Look, the Nasdaq's now 2.5%. Holy crap. In one day, that's an incredible move for an index. Anytime you see that. Wow-y. Let's see. Let's see. Power options. Log in. Is going to be some hell of a number. Oh, portfolios. Look at the OOP 167. Crazy. Money Talk. How did Money Talk do today? Oh, not that much. 111.16. Wait, what was it? 1117, and now that's not much of a move. I would have thought we did better. Now it's 1116. It's done nothing today. All right, so much for that. The long-term portfolio, though, I bet that's going to be exciting because we got really aggressive there. 121%. That's crazy. Oh, there you go. We're very, very bullish, and we're getting rewarded for it. Holy crap. That is nuts. All right. Well, lots of money. Okay. So anyway, so good job, Hal. All right. So Naomi says the last questions. I got to get going. February. All right. Naomi says I sold February 2019 NVIDIA 150 straddle for $19. I did not think it would be hit as hard as it was. Wow. Oh, that sucks. There's $2 in premium on the 150 call, so I will let it expire. Ugh, it's such a volatile stock. The February calls he sold them, and it was not unpredictable. Okay, you got to do this before you start selling straddles and things like that. I understand $19 for the 150 straddle, so you could go from 170 to 130, and that's been the range. So you took a gamble that it would stay in this range, and it didn't. That's the gamble when you're doing those things. You're kind of lucky though, because look at this one, 206 to 130. That's a $70 move. See, I would never ever sell a straddle in a stock that has ever that I could, in the last few years, if it has done something like that, I would not want to do it. And you got to look at the history and say, how much can this thing screw me over? Here's 133 to 174. That's a $40 move. 174 to 124 is a $50 move. That's all in one quarter. 124 to 160 is a $40 move. So you're saying, I did not think it would be hit that hard. It does that all the time. It doesn't even need an earnings report to do that. Here's what is this? 100 to 135. That's 30. It's $35 here. Here this is from 70 to 95. That's $25 at a much lower, at half the price. That again would be, obviously if it's double the price now, it'd be a $50 move. So that's a $50 move. That's a $50 move. That's a $50 move. That's a $50. It happens all the time. You bet something that happens all the time wouldn't happen. I hate those kind of plays. I'm not a fan at all of those kind of plays, and especially on a stock that has a tendency to be violent. So what should I do with the calls? There's a premium that will expire, but could roll. I wouldn't play this stock. I honestly, if you're up a few bucks, you're lucky. You're up a few bucks, and that's that. I really, it's not a good stock to be messing around. You're playing Russian roulette. You're saying, yeah, you got a Russian last name too. That's funny. So I don't know if you are Russian, but that's funny. But you're betting that something that happens almost once a month isn't going to happen to you. And to do what? To make a few bucks? And I know it's fun when you get lucky and you hit your strike. That's great. But it only takes one really bad one for you to be in trouble. And they're not done with their downgrades yet. I don't see these guys improving from here. I think that more people are going to be calling shorts on them. Is this today? This can't be today. This is the weekly. It's down 14% for the week. Today they're up a bit. Okay, so today they're up a bit. I don't think this is the end because I don't see any great catalyst for them to improve. And Sanjay said, "Is Vodafone a good buy?" I honestly don't know. If you ask me in chat, I'll try to look it up. Wow, the Fed is still. I mean, the market is still going up from Powell. He's saying all the right words. Vodafone is generally a good stock. I don't know what they've been doing lately. You can take a quick look at their numbers and see how they look. VOD. Is this Vodafone? Can't see. Vodafone. So, wow, yikes. Look, here's the problem. So they're at 47 billion. They have made, that can't be right. How could they make $70 billion? I don't understand that. Anyway, all right, well, look, they're all over the place. 500 million, God knows what that is, $7 billion, minus 11 billion for 2 years, $2 billion this year they're stringing together, next year 2 billion. So let's say they steady out at 2.4 billion. You're still paying, now you're paying 20 times earnings for a phone company? I don't think so. I mean, it's a cyclical stock, obviously. They could make money, they could lose money. 5G is rolling out. I don't know how ahead of you. Here's the thing. If I was going to play a phone company, I want to know why are they where they are now. I want to know how much are they spending, what's their spending plan over the next couple of years? What are they doing? They've got to be rolling out 5G with everybody else. Otherwise, obviously, they're going to be screwed. Both Verizon and AT&T are spending heavily on 5G. So, and we just talked about that today. So Verizon had okay earnings, and actually, Verizon got rewarded for it because they're like, hey, dudes, that's cool. You're like rolling out 5G, but you're not having the worst quarters. So Verizon from their earnings has actually gone up a bit. They bottomed out at the 200-day moving average. People aren't stupid. They bottomed out where people thought the bottom should be. That's what that is. So they bottomed out where people thought the bottom should be. They're holding this area. They're a good buy over here. AT&T dropped all the way down to 30. See how they ended up now. Yeah, they're like 29 something. But also still hanging around the 200-day moving average, not fooling anybody. They're in a point where they have some very heavy input costs. I like that though. To me, that's the time to buy them. As long as it's because they've made a big investment, I don't mind owning them and dealing with the rough times that they have now. Vodafone got creamed, And I don't know why, and I don't know if they're behind the eight ball, if they've done their investment, maybe they aggressively built and took big losses. I don't know. I mean, it looks to me, if I assume they're not idiots, that shoot. Oh no, not that one. That's why I keep clicking the wrong thing. If they're not idiots, I have to assume this $11 billion is what they spent. And it's not 11 billion, it's 11 billion plus the profits they should have made. So probably another six, so probably $20 billion roughly, building up their 5G network over the last couple of years. And now it's ready to launch. But I also have to be concerned because I don't think I'm going to pay more for 5G. I mean, I guess I will pay more if AT&T says $20 more a month for 5G. I'm going to say, of course I want 5G. That's stupid. But there's nothing, the thing is that 5G has way bigger, longer coverage, and I think it's going to make a lot of smaller, like Sprint maybe is behind, and you know how they're merging with T-Mobile and everything. So Sprint and T-Mobile maybe a bit behind, 10% behind in coverage of AT&T and Verizon, but 5G is probably going to bridge the gaps on the coverage because it's going to have a much wider area, so it's going to fill in all those dead spots to some extent. I mean, it's not so simple, but to some extent, though, it's going to give them better coverage, and that means you're going to have a much more competitive, lower-tier phone companies who are going to compete on price. So I don't think, and again, it goes back to FTR. I don't think if you want to get your money now, if you're looking for quick gains, I think it's probably a terrible time to invest in any phone company. Long term, though, I think that the Internet of Things, in other words, you have a phone and need a constant connection, fine. But soon your car will need a constant connection with a phone too. And so will your home cleaning robot will need it. We're going to all have robots and things like that in the house. Like that movie iRobot where everybody goes crazy, whatever. But you think about, it's over the next 20 years, the Internet of Things, your refrigerator will need a phone or a connection of some sort. Most of them will be Wi-Fi, of course, but your home robot's going to need a constant line. Your car obviously needs a constant line. If you end up having a security drone, if you live in a house, believe me, you're going to want this. You're going to want a drone with a camera flying around, watching for bad guys. That's like, it's that way you don't get burgled or anything else. It's a roving camera that looks for movement to find out if people are approaching your house with no good reason. People are going to want those things. They're going to, there's going to be drones that just kind of charge themselves up and fly around your house and make sure there's nothing bad going on. They're going to constantly scan and watch your home. There'll be drones that fly around taking pictures of your baby too. There's going to be so much stuff. There's robot pets, things like that. You want your robot pet to work in the park. You don't want to leave the house and have your robot pet go womp womp because you left your Wi-Fi zone. That's not nobody's. People don't want that. So the Internet of Things is going to cause a lot more connections to the phone companies and a lot more demand for Wi-Fi everywhere. So the 5G rollout is they're willing to spend $20 billion for a company that makes $40 billion a year, that's $40 billion in revenue. So they're spending, they know they're spending 2 years worth of profit. So they're spending 2 years worth of profit, which is 20% of their total profit for a decade, because they know they need this, because this is the future. And all these people are spending whatever it takes to have these 5G systems ready to go. You don't want to not be the one with 5G. And it's not going to work. So everybody's spending money. All the phone companies are spending out. And it's not unanticipated that this is what's happening. It doesn't make them bad investments. It's just that they're cyclical companies in a spending part of the cycle that are down now. Just like the oil services, frankly. The oil services are ridiculously low right now. but you got to be patient. So if you want to be a patient investor, you want to start building into Vodafone, that's great because they can make $7 billion in a year. They haven't, but they can. And in theory, once they stop, take their foot off the gas on these investments, they should ramp back up. But it's not being projected here. That makes me a little cautious. If we look at AT&T, okay, they're well 29, 19. This is investing. They were making 29. Now they're making 19. They spent $10 billion on something. But then, right, oh, that's not 20. Then they go back to 23, 25. So they're still putting money in. Their max money is 29. And that could have been a fluke for whatever reason. But, you know, they're capable of making quite a bit of money. You can see at least 5% dropping bottom line, 10% bottom line. So they should be making at least 10%. So that's $17 billion, but they're anticipating doing better. And by the way, with 23 billion projected next year, AT&T is only 233, 10 times earnings. You're paying 20 for Vodafone. Why? I can buy a phone company for, it's like a car. It's like, you know, why are you paying $40,000 for the same car I can buy for $20,000? It's like, does AT&T have a better paint job? Is that why you want it? It doesn't make, I mean, Vodafone doesn't make any sense. Verizon, 20 billion projected, $200 billion valuation, 11 times PE. Why am I paying so much more for Vodafone? I don't know. And see, Verizon too, they had 30 billion last year. They put $15 billion in this year. They're going to go back, but apparently they're going to be spending this money forward. Vodafone may have already spent the money. That may explain why they went down further faster. And they may have gone gung-ho all in on it. I don't know. That takes research, and that's something I don't know. I can't do that right now. But I don't see that it would make it. It still wouldn't want me to pay such a premium on their even their potential earnings. It doesn't make any sense. You know, I know Verizon can make $20 billion a year. I know that's a reasonable price. I know AT&T can hit their market cap too. That makes sense. Vodafone, I don't know. I have to have a damn good reason to spend that kind of money for a stock. All right, well, now I actually got late. I was supposed to get out early. Oh, well, thanks, Robin. I appreciate it. All right, guys, thank you so much, and we will do it again next week. I'll be on TV on BNN at 7 o'clock. Everybody write in and tell them how fantastic I am and how I'm their best guest and all that, right? No, they love me. That's why I'm on so much. Anyway, all right, so have a good day, guys, and we will do it again next week. All right, thanks.